Brad Williams, Frugal Finance. I'm going to keep this as short as possible. Convertible bond conversion. There are groups out there that will issue convertible bonds. And what it is, you issue a bond and you can convert it over into stock. And without getting into all the gritty, nitty part of it, I'm just going to point out how to convert that and what it means, why there's an incentive typically for convertible bonds. You'll see convertible bonds on startup companies. Why? Because it's sort of a last resort kind of deal, because it's still fixed income. And as a startup company, you don't want that responsibility. That's money going out. You're paying that money, that interest rate going out, and that money should be going into the company building the infrastructure for your new company. So convertible bonds for startups is a last resort. That means you're running out of money, and equity players are not interested any longer. They're thinking that perhaps your new idea might not be as great as you sold. You are going to go out, and it's typically a preferred convertible. Well, I'm not going any deeper than that. But at some point in time, you're paying interest in some cases. And from the investor's point of view, they took a haircut in terms of the interest rate in order to convert those bonds over into stock. Perhaps you're currently a private company, and at some point in time, there could be some wording features that provide an incentive for the investors to give you the money. A convertible bond is a bond that can be converted into a predetermined number of shares at the option of the bondholder. Generally, it makes no sense to convert at the time of the bond issue. But with time, the conversion becomes a more appealing option as stock prices move higher. Companies generally add conversion options to bonds to lower the interest rate paid on the convertible bonds. Conversion options. With a typical convertible bond arrangement, bondholders are granted the option to convert their bonds into a predetermined number of shares of stock. So there's going to be a conversion ratio or conversion number. So the conversion option basically quantifies the shares of stock that each bond can be swapped for. It's just a number crunching. The market conversion value reflects the current price of the shares for which the bonds are eligible to be exchanged. Conversion premium denotes the surplus of the bond's value over its conversion value. For example, consider a convertible bond with a face value of $1,000, convertible into 50 shares of stock. In this example, the conversion ratio stands at 50. This ratio can also be leveraged to compute a conversion price. To divide 1,000 by 50. This can also be leveraged to compute a conversion price calculated by dividing the face value, 1,000, by the ratio. In this example, the conversion would be $20. If the stock price is below $20, and generally it is when you issue preferred, otherwise, why would you be doing it? It's a call option, and the investor would immediately call the deal if the price was at 21, and you're going, oh, well, that was foolish. Generally, there's going to be this conversion price, and then you also want clearly you want the stock to be at 500, and then at that point in time, you can convert it. But there could also be conversion restrictions, and it'll say, well, despite whatever the price is, you can't convert for at least 3 years, or you can't convert until we go public or something like that. If the current stock price hovers at 25, the market conversion would tally up to $1,250, 50 shares times 25. In another example, the convertible bond is trading at $1,300. The conversion figure climbs to 26. That's it. There's really no magic here. This is a simple example, but with that, here we have a bond, $1,000, current interest rate 5.25, 19 years to maturity, coupon rate 213, convertible bond value today 1064. Value of bond, note negative exponent, 631. So what we're trying to do is figure out equity versus the bond. So we have 631, we have this price, we have the bond, and what we're doing is just taking this coupon rate, times 100, et cetera, and the number of years. So we have this value, 631, and all we're going to do is we're going to take this 1064 minus 631 and 433. That's what the equity's worth. The straight bond, and I just put a big question mark because it's not important, but that's the conversion. We don't need to get any more complex. Now, there are very, very complex conversion calculations. Well, we're not going to worry about that. Let's not get caught up in the weeds here. We just want to know, we want to get a general idea of what that equity is worth, 433 and 631. So you're looking at 63% of the bond price and 43%, 43.3% for the equity. Work through it, work through the numbers, okay, and work through this conversion a couple times, and you'll see your graphs, what I just mentioned. Brad Williams, Frugal Finance, just a brief introduction to bond conversion.